In this video, I'm going to show you a random forest algorithmic trading strategy that has 85% win rate. Random forest is a supervised machine learning algorithm that uses the ensemble machine learning in making predictions. So in this video, we are going to build a random forest algorithmic trading model that can achieve above and see if we can achieve above 80% accuracy with it. The idea is to build an algorithmic trading strategy using random forex algorithm. Then we backtest that strategy and check the equity curve. So this is an educational video. The purpose is teach you how to develop and then backtest an algorithmic trading strategy. So data we'll be using will be pound dollar 30 minute 10,000 bar data comprising almost 1 year. So this is the data for 1 year, 10,000 candles. This is a trend trading strategy. Trend is your friend until it bends. This is what you should remember. Trend trading is where professional traders make their fortunes. However, predicting trends is a challenging task. Long-term trend prediction in modern markets is a difficult and challenging task, and there are many uncertainties. These uncertainties are mostly political events happening around the world that can impact that particular financial market. Breaking news that can impact a certain financial market. Financial markets are dynamic, non-linear systems that have been driven by many factors are difficult to figure out and measure in most cases. So we take financial markets as random and chaotic dynamic systems. In recent years, several people have tried to predict the financial markets using machine learning techniques. So we'll be using this paper predicting the direction of stock market prices using random forest. You can click on this link and read this paper as well. The authors claim achieving a predictive accuracy of 90%, which is astounding. So let's use this paper and build our algorithmic trade for random forest algorithmic trading strategy. So we'll be using Python code. Most of the time you'll find good research papers on quantitative finance that can use to develop your algorithmic trading strategies based on the web. Developing the algorithmic trading strategies will, of course, test your mathematical and programming skills, but the rewards can be very good if you would want a good algorithmic trading strategy that makes good profits for you. So the paper uses relative stack index, stochastic oscillator, William percentile, moving average, convergence, divergence, price rate of change, on balance value. So we'll be using these indicators to predict the target variable, which will be the trend for the next 1 bar, 5 bars, 10 bars, 14 bars, and 30 bars. So 30 bars means 15 hours. So 10 bars means 5 hours. Random forest algorithm. So first let's discuss what a random forest algorithm is. You might be thinking we'll be hunting in a dark forest, sort of, not physically, but in a statistical sense. Random forest algorithm is an ensemble learning algorithm that first builds decision trees. Decision trees have long been a popular algorithm. Decision trees first got introduced in 1970s, have been popular ever since. Decision tree is an intuitive algorithm to translate the prediction rules which can be easily understood by laymen. You don't need to do complex mathematical transformation before using decision tree algorithm, which is one reason why it has been popular. Decision trees algorithm splits the features to a number of statistical measures. Each split is determined such a way that improves the sample. The statistical measure usually used to make splitting decision is the Gini impurity, information gain, and the variance reduction. Information gain based on the information entropy function. Long story short, decision trees split data in such a manner that it minimizes the entropy. Decision trees have one problem. They are prone to overfitting. And this is a problem that we also face in algorithmic trading, overfitting the data. We traders try to be trading rules in our strategy using RSI oversold below 20. We buy and sell when RSI overbought and above. Sounds simple. We can add more rules like buy when RSI is 20 and 30. MACD is changing color. Similarly, sell when RSI is between 18, 70 and MACD. So most of the time you'll find that these rule-based trades will give a losing trade. Why? Because we are overfitting. These rules are like the CNTs, which also fit most of the time. When you all fit the data, the predictions are poor on-scene data. The algorithm fails to separate the single signal from the random noise. The CNTs are more variance than bars. In terms of noisy data, you can improve the CNTs to retain the algorithm using only corrected predicted cases and build a separate tree for the misclassified cases. So you can read all this about the decision trees. So we'll use Python. Let's import the data, and this is the data we have read. So I'll be coding my own technical indicators. We can also install a Python library, which is very good. So this is the code for RSI. This is the code for price rate of change. This is the code for stochastic oscillator. This is the code for Williams percent R. So targets we calculate, and so we have made these calculations for the 10,000 bars. So as I said, we will calculate 6 targets, 1 step ahead, 3 step ahead, 5 step, 10 step, 14 steps, and 30 steps. So we now build a data frame that we will then give to the random forest algorithm, and that will then do the classification for us. So this is the random forest algorithm. We give that data frame that we have made, and we just ask the random forest to classify the targets. These are the results for the different steps. So 1 step accuracy is 50%, well, just like flipping a coin. 10 step accuracy is 75%, which is pretty reasonable, but the best is a 30 step that has 85% predictive accuracy. So now we do the back testing. Algorithmic trading strategy backtesting engine. We develop buy sell impulse signals. Once we have that, we can then use them. Buy impulse signals, but the 30 step prediction changes from -1 to +1, and sell impulse signals, but 30 step ahead price prediction changes from +1 to -1. Keep this in mind. We are using pound dollar 30-minute time frame. 30 steps ahead means 15 hours. So we do the back test. It took roughly like 1 hour. And you see, we have calculated the time. And now we just check the results for the back test. Oh, very good. Wow. This is the equity curve. But there's a caveat. We haven't used the stop loss. So if we don't use the stop loss, so we can easily make 11,665 pips. And maximum drawdown will be roughly like 116 pips. This is the equity curve without the stop loss. But we know as traders, stop loss is essential, because without stop loss, it can be so sudden. So 116 pips. This is the maximum drawdown that the strategy faces. So let's cut this drawdown now. We just use 50 pip stop loss now, and then we again do the calculations, back testing. So now with 50 pips, we have made 7,000 pips. So this is the 50 pip, and now we do just make that calculation. If we deposit $100. Okay, how much we can make in 1 year with this strategy. So with $100, see this calculation after, wow, makes 3 million. Power of compounding, continuous trading, daily 24 hours. We can't do it as humans. And for 1 year, we don't withdraw any money. So you can go through this, all these things. There are some mistakes. So always these two major problems in algorithmic trading is look at bars, so not peaking bars. So we cannot look into the future when making the predictions. And then we have data mining bars and over optimization bars. So I hope you like the video.